Welcome to vTalkInsight, Market Drivers Daily for June 25th, 2026. Micron's blowout results have jolted the AI complex back into a full risk-on phase, just as inflation data and expectations for Federal Reserve hikes turn more hawkish. Let's unpack what this evolving AI build-out means for the tech ecosystem, equity leadership, and inflation path into year-end. The latest numbers from Micron have turned yesterday's key risk event into a powerful confirmation of a structural AI infrastructure cycle. Revenue overshot expectations by a large margin. Gross margins are now in the mid-80s, and management signals they are effectively sold out on key AI memory products well into December 31st, 2027 and beyond. That combination of long-dated, enforceable customer contracts and tight supply suggests memory has moved from a cyclical commodity to a strategic choke point in the AI stack. Customers are prioritizing guaranteed access over price, and average selling prices for DRAM and NAND have surged, underlining that pricing power has shifted decisively to a handful of global suppliers. Under the surface, the AI hardware and software landscape is starting to mature. The phase of rapid experimentation and niche solutions is gradually giving way to broader, general-purpose AI platforms, even as open-source software stacks and architectures such as RISC-V gain traction among enterprises that want more control over their infrastructure. Capital spending is scaling accordingly. Global AI infrastructure capex is on track to exceed $1 trillion next year. Enterprise demand growth for AI infrastructure has accelerated from around 30% to well over 100% year-on-year, and many firms have already blown through their initial AI budgets in the first quarter. Despite that surge, reported cash returns on AI infrastructure, near 29%, still comfortably exceed funding costs, while corporate leverage and system-wide debt metrics remain moderate compared with past tech bubbles. That helps explain why the current late-stage bubble narrative in AI may be persistent rather than immediately self-correcting. The investable AI ecosystem is also widening beyond headline GPU suppliers. The rapid build-out of data centers is pushing up demand for cooling, electrification equipment, grid connections, and even materials like copper, turning these bottlenecks into potential profit pools. AI-driven power needs are accelerating capital into firm, low-carbon energy sources such as nuclear, storage, and renewables, with speed to power now a critical competitive edge for both utilities and cloud providers. At the same time, companies like Qualcomm are repositioning from smartphones toward AI data center chips, targeting multi-billion-dollar revenue streams by the end of the decade, while OpenAI is rolling out custom silicon that aims to cut compute costs by around half. Emerging markets are getting pulled into this story as well. Amazon's plans to invest tens of billions of dollars into AI and cloud infrastructure in India underscore how talent constraints in the United States and Europe are shifting some growth to new hubs. Against that bullish backdrop, the risk side of the AI trend is becoming harder to ignore. Rapid AI deployment is transforming cybersecurity, with attackers already leveraging machine-driven techniques that outpace traditional defenses, while investment in AI security still lags the size of transformation budgets. Some organizations are now pausing or rolling back AI use in sensitive systems because of data protection and regulatory concerns, and frontier AI labs face targeted cyber campaigns and intellectual property risks, highlighted by disputes such as Anthropic's allegations against Alibaba. Market outcomes are diverging as well. While memory and infrastructure leaders rally on strong earnings, weaker or overhyped names like Cerberus Systems are suffering sharp drawdowns after disappointing guidance. And there is open skepticism about whether today's extraordinary chip margins can be sustained for many quarters. Looking ahead, the key watch points are how quickly AI security and governance spending catches up, whether hyperscalers maintain current capex plans, and how export controls and IP rules evolve. In short, AI remains a powerful structural growth engine, but with increasing dispersion that makes selection and risk management more important than broad theme exposure, setting the stage for the way these fundamentals are now driving price action in listed tech. In equity markets, Micron's results have flipped the script from yesterday's semiconductor-led stress to a fresh tech rally. The stock is up well over 16%. Nasdaq futures are outperforming, and optimism is spilling across the global chip complex. European names like ASML are rallying as investors extrapolate tight memory supply and robust AI demand into their own order books, while Asian indices, such as the Kospi, are getting a lift from strength in local champions like SK Hynix. Compared with the sharp, ETF-amplified volatility in chips we saw earlier this week, today's tape looks more like a classic earnings-driven relief move, anchored in very strong fundamentals rather than just positioning. Leadership within tech is clearly rotating toward the beneficiaries of AI capex. Micron, NVIDIA, Broadcom, and peers are all cited as enjoying strong earnings momentum, with valuations still below the broader market on traditional metrics, while Samsung and SK Hynix trade on single-digit multiples despite robust profit growth. Qualcomm has added to the positive tone by outlining an ambitious AI data center roadmap, with high-confidence revenue targets in the mid-single-digit billions and upside scenarios toward $15 billion as custom chips gain share. Beyond semiconductors, large U.S. banks are also contributing to the pro-risk mood. Firms like J.P. Morgan continue to post returns on equity around 20% and invest heavily in technology, and major banks are now upgrading S&P 500 targets as earnings breadth improves across sectors. Underneath the headline indices, the rally is increasingly selective. Mega-cap hyperscalers are lagging as their heavy capex bills fund the AI build-out, while memory, chip equipment, and industrial names geared to data center and infrastructure demand, such as Applied Materials and Caterpillar, are outperforming. There are also signs of crowding. Retail traders on platforms like Robinhood are aggressively buying dips in AI and memory stocks. Passive flows and momentum strategies are chasing recent winners, and leveraged and single-stock ETFs in markets, such as South Korea, are amplifying both up and down moves. Earlier in the week, this same structure contributed to 8% type intraday swings in chip indices. Today, it is magnifying the upside. With so much performance hinging on a narrow group of AI-related names, concentration risk is front and center. New vehicles like so-called Trump accounts are expected to direct tens of billions of dollars into U.S. equities, with a heavy bias toward tech, adding a potentially price-insensitive tailwind through the summer. At the same time, some active managers are quietly trimming AI-centric positions, even as passive and leveraged flows push prices higher, and defensive sectors such as staples and pharma are waiting in the wings should AI-driven profitability disappoint or policy turn more restrictive. Key signals from here will be the durability of earnings beats across the chip supply chain, the extent to which leadership broadens beyond semis, and whether volatility in derivatives and ETF stays contained. All of that links directly into the third driver today, which is the way AI-related cost pressures are feeding back into the inflation and interest rate narrative. The inflation backdrop is becoming more challenging again, even as growth remains solid. Core PCE inflation is expected to stay above 3% through year-end, with some forecasts pointing to year-over-year readings around 4.1% and quarter-on-quarter rates at multi-year highs. Recent data already show core PCE running near 3.4%, and official metrics like CPI and PCE have now sat above the Federal Reserve's 2% target for 5 consecutive years. Markets are responding. One-year break-even inflation sits around 1.7%, and swaps near 2.3%, levels that look low compared with recent headline inflation annualizing near 8% on a 3-month basis. And pricing is shifting toward a high probability of a July rate hike and up to 3 moves this year. The AI hardware boom is now a visible contributor to those inflation pressures. Structural demand for high-bandwidth memory and DRAM, combined with multi-year capacity constraints, has pushed average selling prices up between 60 and 80%, with some suppliers expecting a further 20 to 30% increase in the next couple of quarters. For major tech buyers, that is feeding straight into end-user prices. Apple, Dell, and others are raising tags on devices by 10 to 30%, with some products like tablets seeing hikes of up to 25% as companies can no longer absorb exploding memory costs. Electronics carry a relatively small weight in consumer price baskets, but categories such as software and accessories have seen record price gains, and there is a growing view that standard inflation measures may understate the true impact of these tech-related increases. Beyond chips, inflation pressures remain broad-based. Core services and food costs are still rising, Producer prices and supply chain surveys point to ongoing cost pass-through, and energy price volatility is likely to drive headline swings over the summer, especially as geopolitical risks flare in key shipping lanes. Nominal GDP growth of roughly 5.5% to 6% is being supported by resilient consumption, fiscal spending, and AI-related capex, but that strength comes with inflation still well above target. In markets, elevated real yields and a firm U.S. dollar are weighing on traditional hedges like gold, silver, and crypto assets, while persistent upside surprises in inflation increase the risk that the recent rally in government bonds runs out of steam as the Fed stays focused on price stability over labor concerns. There are some offsets to the more hawkish narrative. Lower oil prices earlier in the year, signs of easing geopolitical tensions, and the relatively small weight of electronics in inflation baskets all argue that AI-driven chip costs alone may not push headline inflation dramatically higher. Over the longer term, AI-enabled productivity gains could prove disinflationary, although those benefits have yet to show up meaningfully in earnings or macro data, and the timing remains uncertain. Household finances are also sending mixed signals. In some segments, wage growth is failing to keep up with prices for essentials, pressuring low and middle-income consumers, while other data point to wage growth still above trend and balance sheets supported by cash buffers, consistent with a soft landing rather than a hard downturn. For now, AI investment appears likely to stay robust even under modestly higher rates, given high reported returns on these projects. The next catalyst on the inflation front will be upcoming PCE releases, University of Michigan inflation expectations, and continued evidence on memory pricing and consumer resistance to tech price hikes, all of which will shape how long this combination of strong growth, elevated tech earnings, and sticky inflation can coexist. Micron's results and the broader AI build-out are pushing markets deeper into a structural, supply-constrained cycle that favors memory, infrastructure, and energy over the previous generation of tech leaders. At the same time, that same capex wave is complicating the inflation picture and keeping the Federal Reserve on a more hawkish footing, even as equities enjoy another leg of tech-led strength. For market participants, the key from here is how quickly AI earnings broaden beyond a narrow group of chip makers, whether volatility from crowded trade stays manageable, and how fast inflation pressures, especially from AI hardware and power, begin to ease. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.